In a highly valued market like this one, there are still opportunities for investors to find companies that have huge upside and that are trading for a reasonable valuation. What I'm looking for is durable, sustainable growth and just a fair price. Some of these stocks are going to be the cheapest on the market. Typically, you're going to have to pay up for quality, but there are still reasonable values out there that have 50% upside over the next year or two. I'm going to dig into 5 of those stocks today. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with one of my favorite stocks coming into 2025 that has done extremely well. That is Lyft. Shares of Lyft are actually up 62% so far this year. A lot of those gains have come just in the past couple of months, and that's because the market has started to realize this is an aggregator of demand in a world that's moving to more autonomous vehicles. And that autonomy should bring down the cost of vehicles and it should expand the market. Those two things should be extremely bullish for Lyft long term. And when you look at what you're paying for the stock, it's relatively reasonably priced. 1.3 times sales today. A couple of months ago, that valuation was more like 0.8 or 0.9 times sales on a forward price to earnings multiple. This is up to 18. Like I said, a few months ago, this was 10, 11, 12 times forward earnings. This is still a pretty reasonable valuation for a company that continues to grow. Here's a look at Lyft's revenue and net income improvement over just the past few years. You can see that there's been steady revenue growth, almost an 18% compound annual growth rate, and then net income is now positive. Lyft also has a pretty solid balance sheet, paid off a fair amount of their debt recently, but still has over $1 billion in net cash on the balance sheet. So when you look at the valuation for Lyft, see the market cap of $9.2 billion. Really, that's about $8.2 billion in enterprise value because got a solid balance sheet, solid growth company. I think a really fair price. They are in the number 2 position, and that's behind Uber, the second stock that I think still has a lot of upside. If you like Lyft, you should really like the business operations of Uber. It's actually a faster growing company. It's more profitable. I think there's really more power in being a bigger aggregator, but you are paying a little bit higher price, $205 billion market cap. Enterprise value is about the same. Price to earnings multiple on a forward basis, you're looking at about 31. So not the cheapest stock on the market, but that's a reasonable price to earnings multiple for a company that's growing revenue at a 23% compound annual growth rate over the past 3 years and 32% over the past 5 years. The other thing that really differentiates Uber versus Lyft is that it's a much more diverse business. You do have the mobility business, that's what Lyft does, but then you have the delivery business as well. For quite a while, this was actually growing faster than the mobility business. That's kind of changed a little bit in the past couple of years. Mobility has had a really good run, but again, leaning hard into autonomy. And I think that's really where the future 10x potential for Lyft and Uber is going to be. They are going to be the demand sources, and they're trying to commoditize their supply as much as you can. You can see that they've got agreements with companies like Waymo, May Mobility, Baidu. There's close to a dozen companies today that these two are working with to bring more autonomous vehicles to the market. That means that pricing power is not going to be with the autonomous vehicle supplier. Pricing power is going to be with Lyft and Uber. So those are 2 stocks that I think have a lot of potential as the market realizes the growth opportunity ahead for them. The third stock, in keeping it simple, is Alphabet. Alphabet, one of the most powerful companies in the world. And I think when you look at the future of artificial intelligence, of technology, this is a company that's going to be at the core of all of that. The Gemini app is now being downloaded more than ChatGPT, so gaining market share there. That was potentially a point of disruption. But the search business, not really being disrupted, still growing double digits. Then you have YouTube, where you're watching this here today. That is an absolute juggernaut. The most streamed service is YouTube. It's not Netflix. It's not Disney Plus. It is YouTube by a mile, and they're continuing to grow and take market share. That power is going to continue to grow because, again, it has aggregated all of the demand, and producers and content producers like myself, the best place for us to go is YouTube. It's a symbiotic relationship that's a win-win-win for creators, for YouTube, and for users. On top of that, you have the Android ecosystem, everything that could come from that. They're moving that into more wearable devices. That's things like watches and glasses, where you're going to potentially be able to bring some of those AR and AI technologies to life. And let's not forget about Waymo, one of those suppliers to Uber and Lyft. This is the real leader in autonomous driving. You get all of that today for a 27 price to earnings multiple. Yes, that valuation was a little bit better a couple of months ago. If you were watching this channel a couple of months ago, you would know Alphabet has been one of my favorite stocks over the past year. And the recent run up has made the valuation a little bit higher, but it's definitely not the highest valuation we see in the market. And when you have a 10-year compound annual growth rate of 18%, and look at this 20-year chart, there are just not many companies that can compound revenue at 20+% and net income at 25% for 2 decades. Just a phenomenal business trading at a really fair price. I think over the next year, the market's really going to figure out this is the best play in artificial intelligence. Google Cloud continues to take market share. Google's models continue to show that they're some of the best in the market. And this is the only company that has an ecosystem outside of NVIDIA as far as chips go with TPUs. So I love where Alphabet is sitting today. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Stock number 4, let's go a little bit contrarian and on the valuation side. That is Disney. I like Disney stock because there's a lot of things from Disney that other companies simply can't do. Nobody has the brands that Disney has. Nobody has the parks that Disney has. And now when you look at the future of streaming, you have Disney Plus for kids and families. You have Hulu for general entertainment. And they own a vast majority of ESPN. That recently went over the top. We don't have the numbers behind how many subscribers there are now, but that's a very good service. And as they pull more and more content into ESPN, particularly from the NFL, I think that's going to become a bigger and bigger business. Hasn't been a growth business for a few years. This could now be a growth business in sports, and you're getting a really good valuation. Price to earnings multiple is just 18. Yes, there's a little bit of debt on the balance sheet, but nothing that's too unmanageable at about net debt of about $40 billion. And if you're looking at Disney, this is really the foundation. Not a massive growth business, but parks and experiences, compound annual growth rate is about 7% over the past few years. And an insanely profitable business doing about $10 billion in operating income. So when you look at that $250 billion enterprise value, that's only 25 times the operating income just from what you're getting from the parks business. That doesn't pull in any of the other studios, the movies that they're doing, or the streaming service. This is the operating income from entertainment and sports, and you can see not a terrible business. Almost $8 billion in operating income and improving. They have gone through some cost cuts over the past few years. Those have been very successful. And I think we're starting to see that the content is getting better on all of these services. So that's really the core. That's the value core for Disney. The upside is in streaming. And here's where they have 207.4 million combined subscribers. That's across Disney Plus, ESPN Plus. That will now become ESPN. So we'll see how they report that in the next quarter. And then Hulu as well. Not quite as much as Netflix's 300 million subscribers, but the pricing power is pretty compelling. Actually, Disney Plus announced that they're going to be having another price increase this fall. I think that's something they're going to continue to push on, and they're going to continue to push people towards bundling all of these products together. Disney wants to have people subscribe to Disney Plus, Hulu, and ESPN, and then maybe even add in some other services. You already have NFL Plus available as an add-on. Fox is coming as an add-on. So that's really where they want to be, is the future of the media business. And I think that's a compelling offering when you're getting it for a price to earnings multiple that's in the teens. Look, Disney is going nowhere. As many questions as a lot of these media companies have, Disney is the one company that always seems to stand alone. There's Netflix, they are the leader in streaming. But then when you get to the next tier, the more legacy companies, the companies that have exposure to sports, Disney is always mentioned as the number one. I think that's going to ultimately pay off for investors. And finally, the stock that I cannot quit, that is Crocs. $4.4 billion market cap. They are paying down debt, but look at this forward price to earnings multiple, just 7.7. This is despite the fact that management actually put out some pretty weak guidance for the rest of this year, partially due to higher costs from tariffs, partially due to just questions about consumers and what are consumers going to be spending their money on. But look at these cash flow trends for Crocs. This is actually a 20-year chart. So I'll make this a little bit smaller here. We'll go to the last 7 or 8 years. You can see that they were generating almost $1 billion in cash flow in 2024. Some of that is pulled back in 2025 as they've made some changes to their inventories. Like I said, they had a disappointing quarter or two, but I don't think fundamentally Crocs is a business that is being disrupted. I don't think it's going anywhere. There are just ebbs and flows in the demand that's coming from consumers that are a little bit stretched now. But when consumers get stretched, where are they going to go? They're going to go to affordable products like Crocs. I think that puts them in a pretty good position. And so if we have a little, even a small uptick in their growth, maybe a little bit better performance as far as their margins of profitability go. This is a company that's going to have multiple expansion because it has a price to earnings multiple on a forward basis of just 7.7. So I think that's a great valuation from a company that long term is still growing. The 5 stocks I talked about today: Lyft, Uber, Alphabet, Disney, and Crocs. Which one of those is your favorite? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.